Hey everybody, we'd like to welcome you to the Wealth Summit bonus, the pension course Wealth Advisory with David Blain. A few things first. If you have any questions, please write them down and save them for the end. We will go over them at that time. So for now, I will turn it over to Larry Soul to introduce David. Larry?
Yeah, thanks everyone for joining today. And those who have the honor of knowing David Blain, I've known you for a couple of years. We're excited for this webinar today. He's the founder, CEO, and wealth advisor at BlueSky Wealth Advisors, a fee-only independent registered investment advisor. David Blain is recognized speaker on investments, financial planning, and taxes. He's written and quoted in numerous trade journals and mass media outlets, including Money, Business Week, U.S. News, and World Report, and the Wall Street Journal. Under his leadership, BlueSky has received several awards and accolades throughout its history for their quality advice, growth rate, client satisfaction. He graduated in 1989 with a bachelor's degree of science from West Point, and he served in the U.S. Army Airborne Ranger and Special Operations Unit. David lives in Trent Woods, North Carolina, with his wife and 5 children. So we're excited to have you here today, David, and you can take it away.
Okay, yeah, thanks a lot, Larry. Appreciate that introduction. Welcome today, everyone, to the first course of our pension plan that we're going to be running over the next several weeks here. So I've outlined here today will be just an overview. We'll talk about pension planning in general and some of the key concepts that you need to understand. We'll also touch base on 2 specific types of plans, the simple and the SEP IRA as an introduction today. And throughout the course, real treat for everybody, I've actually created some case studies of a small 2-person company, kind of like a consultant with an assistant, and then a sort of smallish company with about 13 employees. And as we go through each one of the different types of plans, I'm actually going to bring up our pension design software and kind of give you a sample of what that looks like. So we've got a great course here. Next time we'll talk about the Safe Harbor Solo 401k. Then session 3 and 4, we'll get into some advanced plans, including defined pension plans. And then for session 5, we'll talk about a really unique animal called a non-qualified deferred compensation plan. So we've got a really lot of exciting things coming up here today. So this little funny cartoon here, I like to bring a little humor into this. As Nate said, if you have questions, go ahead and write them down. I got some things to go through, but we'll save plenty of time at the end for questions. So when you're thinking about retirement, don't recommend this strategy, getting Swedish citizenship. So what are the reasons you would want to offer a pension or retirement plan? So number 1 is to create that source of passive income as part of your business exit strategy, creating that passive residual income, as David talks about all the time. And it becomes one of the main pillars of financial independence. And then also diversifying your net worth outside your business. As you know, that's what it was all about in Maui, is creating sources of income, generating net worth outside of your business so you don't have all your eggs sort of in one basket. And the neat thing about while doing all 3 of those things is the last one there, the tax advantages for the employer. And if you're a corporation, for yourself as the employee, there's some huge tax advantages to retirement plans. The IRS code is very favorable towards employers and employees who put away money for their retirement. So let's dig into a few of those details as far as what they actually are. On the employer side, employer contributions are in fact tax deductible, so they reduce your income dollar for dollar. So if you're making, $200,000 of net income and you put 50 into a retirement plan, your net income for the IRS will be $150,000. The way that you can structure plans, there's some generous opportunities for owners. Not only owners, but typically more highly compensated employees. If you follow the rules and some of the non-discrimination testing, you can really sock away a lot of money. which leads us into the flexible plan options. There are different plans that you can contribute to some years and not in others. Others require mandatory contributions of a high level, others of a low level. So there's a tremendous amount of opportunity to design a plan that meets the needs of not only you as the owner, but of your employees, both now and into the future. There are some tax credits for starting a retirement plan. As I said, the IRS views this as very favorable. It's one of the things that the government wants to encourage, keeps people off of the government dole. So they want people to start retirement plans. They want employers to make generous contributions. And in return, they allow them to make them for themselves as the owners. The last bullet here, I think, is underestimated. The ability to attract and retain employees, especially in certain fields. This is very important. Most employees today are rather savvy. They understand that the retirement is their own future. And unlike us as business owners, on maybe a little bit different track, these are people trying to accumulate that nest egg. And the company-based retirement plan is a fantastic way to do that. So while we're saving some tax and diversifying your net worth outside of your business and all those great things, keep in mind too that you're going to be able to attract and retain better employees with a retirement plan as well. Some of the specific benefits to the employee, of course, the tax on contributions and gains is deferred. So there's no tax due putting it in. Now we'll talk a little bit about what's called the Roth option in a minute. So this is not always 100% true, but the gains on whatever investment account it's in are in fact deferred, or in the case of a Roth, tax-free forever. Number two is portability. Unlike the old defined benefit pension plans, that you had with IBM or the government or military, the type of retirement plans that we're talking about here are for the most part portable, and the employee can take the money with them when they go to a different employer. It allows for them to make automated payroll deduction savings. As you've probably heard, the best way to accumulate wealth in an investment type account is to pay yourself first. Take it right off the top. For some of your lower earning employees, there is something also, in addition to the fact that these contributions are tax deductible, there's actually something called a retirement savings contribution credit, where they get a credit on their tax return for putting money into a retirement account. And so if you recall from your basic tax, a deduction reduces your tax income, a credit offsets dollar for dollar the tax that you owe. Of course, another benefit for the employee is the compound growth from within the plan. It grows tax-free. And just like for the business owner, this gives them an opportunity to create financial independence and residual income. Now, there are some downsides to company retirement plans. Number one, cost and fees, poor investment choices, frankly, Wall Street and the insurance companies. Those first three are kind of tied in together. Although this is changing significantly. We work with a number of companies and are able to establish very low cost, very efficient from a fee perspective plans, but your traditional retirement plans of companies were sort of dominated by the insurance companies and Wall Street, and they were typically laden with a lot of fees and costs. So you have to be careful with that and the people that you team up with. Number four there, sometimes it's hard to end the plan. If you start a retirement plan and for whatever reason you want to shut it down, sometimes it can be a little bit difficult with some of the more advanced type plans. Same thing, regulatory filings. This doesn't impact some of the simpler retirement plans, but as your plan grows or some of the more complicated ones, you definitely have to rely on actuaries and third-party administrators and other professionals to help with the regulatory filings. And then the last bullet point, we're going to talk a little bit more in a future today about this, but you may actually be in a higher tax bracket in the future. And so you have to look at, when you're deferring tax today, what does the future look like? But all in all, the positives outweigh these, but there are some downsides that you need to consider. I love this slide here. Would you like to hear about a retirement plan? Basically, they don't have one. They encase that people there in the desk and they never get to leave. So that's obviously not the kind of plan that you want. I've created this chart here to help illustrate all the different types of plans that are out there. And so under the one bucket, we'll deal with the easy one, sort of off there to the right-hand side, the non-qualified deferred compensation plan. So these are, the term non-qualified means they're not tax qualified. You don't have to follow all the rules of the IRS, but you can put money away into a specific type of retirement plan. We'll cover that in our 5th pension course meeting. So we'll kind of set that one to the side for now. The majority of the plans we'll talk about is what are called tax qualified, and they're broken down into 3 different types. Number one on the far left is your defined contribution plans. A defined contribution plan is where the amount going into the plan is set, that you have employees putting in money or employers putting in money, but the amount is set, and then the growth of that account is really dependent on what the account is invested in. You know, stocks, bonds, real estate, what is it invested in, it grows in, but the contribution amount is set. The second one in the middle, which are defined benefit plans, you don't quite see these as common anymore, but this is your traditional, you know, government or military pension, or some of the, you know, IBM or Coca-Cola back in their heydays used to offer these. And these are pension plans. Of course, the automakers are famous for offering these that continually bankrupt them. But they offer a specified benefit based on some sort of formula on how many years you worked, you know, how much you made while you worked there, and they offer to pay you a set amount, a defined benefit for the rest of your life. And they come in 2 flavors. Number one is the annuity based, which is like the government pension. And then the last one there, the cash balance. So this is a really neat option that we're going to delve into in session 3 and 4. Now, highlighted in yellow are what are called the IRA-based plans, and that's what we're going to talk about today. The IRA-based plans include a simple IRA or a SEP and a simple plan. So we'll talk about those in more detail here as we go along. So that's kind of the overview of the different types of plans that are out there. Now, what exactly is a retirement plan? Now, if you'll bear with me a little bit, I tried to come up with an analogy. I've been using this for many years, explaining it to people. So a retirement plan, think of it like a shopping mall. And when you walk in that shopping mall, you get a shopping cart, and that's your account, and it's empty. And the IRS, who's the mall owner, sets the rules as to how much money you have to spend, what types of things you can put in your cart, and when you can take the cash out of the stores and ultimately out of the mall. And so you take your cart and you walk around the mall and you see different stores. Those are like the custodians. So a retirement plan, you can have a custodian at like Vanguard or Schwab, or you could have a self-directed custodian like New Horizons. So there are different custodians that will hold your pension plan money, and they allow you to put different things in your cart. You know, some of them just stocks and bonds, other of them allow more esoteric things like real estate, private investments, and those type of things. Now, continuing with this analogy, you can change stores if you want. So if you go into the Schwab store with your pension plan and you later, you know, don't like that, as a company, you can switch to Vanguard. As an employee, the rules are a little bit more restrictive, but suffice to say, you aren't locked into the same custodian forever. Now, the idea is while you're in the mall with things in your shopping cart, that they're getting more valuable. You know, they're growing. You're, unlike a product that you buy at a mall, we're investing in things in your shopping cart and they become more valuable. Now, but once you cash in and take your money out of the mall, you can never put it back. And at some point, the IRS actually forces you to cash in some of your items and take cash out of the mall. And of course, that's when they get paid. So while everything stays within that environment, there's no tax, but as soon as you pull cash out of the mall, that's when you pay tax. So that's the way I kind of think of retirement. Some people think, you know, they get confused between an account, a retirement plan, a mutual fund, the investments. And so that's a little analogy that I like to use to help keep it straight. So let's move on now to how to select a company retirement plan. as you saw on the previous slide, there's a myriad of different types of plans available. And so how do you go about selecting one? So one of the first things you have to ask yourself is, how much money do you have available? If you're a startup and you have no excess money, that's going to lend you towards one type of plan. If you're a more mature business and you make a ton of money, that's going to lead you to a different type of retirement plan. So that's one of the first considerations. Second is, who are you trying to benefit most? Are you trying to skew the benefits towards the owners? Are you trying to skew the benefits towards employees? Maybe both. Maybe you want to carve out your top selling salespeople and make sure that you're benefiting them, or you want to benefit people that have been at your company for 15, 20 years. Figuring out who you're trying to benefit is a key component of pension plan design. Kind of related to that is who works at your company. If you are significantly older and make a lot more money than everyone else in your company, then that lends us to one type of plan. If you're the same age, or if you're younger than most people at your company, or you make about the same, it tends to skew you into a different type of plan. We also want to look at what your tax bracket is now and what it will be in the future. What is your marginal tax bracket today? Of course, with the new Section 199A deduction, should be a little bit lower than last year, but as everybody knows, those rules are set to expire. And so this is a big question: is where are you paying taxes today versus tomorrow? And then the last one is really interesting: is will you actually need the money in the future? Believe it or not, a lot of people sock away money into their retirement plan, and they sell their company or they own it passively, and they never actually need to spend the money in their retirement plan, and it ultimately ends up going to their heirs. And so that's a big consideration when designing a plan as well, is if you'll actually need the money to live on. Okay, so one of the big factors of retirement plan is the tax deferral. And a couple of points here that I want to talk about. Number one is tax bracket arbitrage. We just mentioned that. What's the rate today versus the rate when you take the money out? If you, for example, if you save $1 million in your 401k plan and you were in the 25% tax bracket, you would have saved roughly $250,000 in taxes. Now, if you're raising a family and you have a home mortgage and things like that, you may be in that 25% bracket may be low. And in fact, when you retire without all those other expenses, you may end up being in a higher tax bracket. So you really have to take a look at the future, and as best as possible, try to make an educated guess as to where you will be in the future. Of course, those tax savings have a time value of money. They grow also at the rate of return that the rest of your account is growing. So you have to take that into account. And as you go along, unlike a regular account, a retirement account is tax deferred. So if you buy some stock and it goes up, 10%, you don't pay tax on the growth of that stock until you sell it. Similar to the way your own company grows, tax deferred as well. The last factor is what I want to talk about is the RMD. RMD stands for required minimum distributions. When you reach the age of 70 and a half, with the exception of the Roth option, you're required to start taking money out of your IRA. The IRS mandates that you take money out. So this, sometimes if you don't need the money, it can be a little bit of a shock. So for example, if you have $1 million saved in your retirement account at age 70 and a half, you'll have to take out about $36,500 from that account, whether you need it or not, and pay tax on it. So you have to consider that. You also have to consider that if you don't actually spend all the money in your IRA, that it's going to be inherited by somebody, and taking their tax bracket into account as well. So if they're going to be in a lower tax bracket than you and they inherit it, then the overall tax rate that's paid through your lifetime and theirs is going to be a lot lower. Or if they inherit and they're in a higher tax bracket, it can actually be a negative. So it requires a lot of planning to maximize tax deferral. And it's not always so simple as just picking a tax-free option versus a tax-deferred option. There are a lot of factors that go into this. Typically, we see people, obviously, if you're in the 10 or 12% marginal bracket today, you should be doing a Roth option pretty much. If you're in the 32, 35, or 37 marginal bracket, we're typically going to encourage you to do the pre-tax option. It's the people in the 22 to 24% marginal bracket, once again, marginal, not effective rate. There, it gets a little bit more difficult, the decision-making process with what to do, the Roth or the regular option. So let's talk about that a little bit more. So the Roth option versus a traditional tax deferred. So a Roth option, you do not get a deduction for putting the money in. With a traditional tax deferred, you get a tax deduction when you put the money in. With the Roth, you do not. Both of them grow tax-free. The traditional tax deferred option, you pay money when you take it out, because remember, you got the tax deduction in the beginning when it went in. And so when you take it out, the IRS is standing there saying, hey, we would like our money. And you have to pay income tax at that point. With the Roth, it's a little bit different. You put the money in to the Roth, but you do not get a tax deduction when you put it in. It also grows tax-free. But when you take it out, there's no income tax owed. So once again, looking at what your tax bracket is today and what it is in the future is a critical decision to make with this option. Now, one thing I like to point out, because the Roth is sort of not always the right option for everyone. For example, if you can take a tax deduction today at 24%, and you leave that Roth to your children, and you don't need it, and you leave it to your children who are in a lower tax bracket someday, then you've wasted that 24% tax deduction if you use the Roth, where you should have taken the tax deferred option, reduce your tax by 24%, and then let them inherit it and pay tax at a lower rate. So you really have to look at all the different factors in determining whether the Roth or traditional tax deferred option is appropriate for you. Especially as you get into the higher tax brackets, we like to see the tax deferred, and this kind of beyond the scope of the pension plan, but you can always do backdoor Roth to get some money into the Roth IRA. Another factor with this is you're only making this decision with your money as the employee. So every retirement plan is going to have a component of employee money. Some of them, there is no employee money, as we'll see in a minute with the SEP. With a 401k, the employee defers money into it, and the company matches or puts money in as well. The company portion contributed to a retirement plan is always a pre-tax contribution. Keep that in mind. So if you have a very generous profit sharing component to your retirement plan, you may want to do the Roth option for your deferrals as an employee, and then the company's portion of the profit sharing goes in pre-tax. So this all goes into the plan design, and not only the plan design for you as the owner, but then making an individual decision with your own contributions to do the Roth or the pre-tax option. Okay, there's a couple other considerations that I like to point out when designing a retirement plan and figuring out what's best for you as an individual, what's best for you as a company. And number one is Social Security benefits. And I always hear, the thing, oh, Social Security isn't going to be there, and why do I want to waste my money on that? The reality is, day in and day out today, especially if you're, over age 50 or so, Social Security pays, those checks come in like clockwork. Government shutdown or no government shutdown, the printing presses are running. And actually, depending on where your business is, it can be a nice diversified stream of income. If you have a husband and wife that are fairly high earning, and wait to take their Social Security until the latest amount possible, that's worth $75,000, $80,000 a year to you. Now, the reason it's on this slide is because now if you're maxing your Social Security at age 25, yeah, a lot of those dollars, the rate of return on the Social Security tax that you're paying is going to be negative. But if you are close to retirement, this is a neat little trick, especially if you have low earning years. So you own this S Corp, and all you've heard all these years is, take as low a salary as possible, take a lowest salary as possible, minimize your Social Security and Medicare, which is fine when you're younger. But then when you turn around to go retire and maybe draw on it, and you realize you have no benefits, the benefit is based on your high 35 years of earnings. And so if you're, to the extent that you're replacing some low earning years or even zero earning years, you can really benefit the Social Security. And if you're doing this later in life, the payback comes fairly rapidly. And so there is actually a positive expected rate of return on those Social Security contributions if you're fairly close to retirement. The other case that comes in, I was just talking to somebody the other day, is when the spouse's benefit is less than half of the other spouse's benefit. So essentially, one person's Social Security is now paying out 100% to the beneficiary, and then half of that amount to the spouse. That's when you can really sort of play the game by maximizing your Social Security in some of those later earning years to really maximize that benefit. Of course, the wage base, the most you'll ever get paid on Social Security is $132,900 for 2019. So there's really not a lot of, if you're looking at the Social Security strategy, there's no sense in going over that. Now, there are some reasons to max a 401k. It's about $148,000, and some of the other plans you may need more. But for the Social Security, there's never a benefit to going over that 132.9 figure. The next thing I want to talk about is the Section 199 implications. So there's a lot of complexity of Section 199, but suffice to say, if you make over the threshold amounts, which for this year, married filing jointly are $321,400. If you're single, it's $167,700. Your ability to deduct that 20% of your business income can be impacted by the amount of W-2 wages paid in your company. And we actually are seeing this with people that came in to us too late in the year, but in 2008, they're missing out on their Section 199A deduction because they didn't pay enough in salary and wages to maximize that 199A deduction. Now, if you have a bunch of employees and things like that, it may not be applicable because your 199A deduction is limited to 50% of the wages paid. So if you have a lot of wages, it's not a concern. But in these 1 or 2 person companies, or even 3, 4, you can limit the amount of deduction that you have if you're not careful by paying yourself too low of a wage. I did some math, and when you look at it, if you have just yourself as an employee, the optimal salary is 27.9% of your business income. At that point, you're maximizing the 20% 199A deduction without paying excess Social Security and Medicare tax. But that's one of the other implications of the retirement plan is, so you're putting money away tax deferred, you're lowering your company's taxable income, you may be increasing your Social Security benefits, and you may be qualifying for more Section 199A deductions. So there's a lot tied up in the design and implementation of a retirement plan. This is one of my favorite little cartoons, about the tax code. It is very confusing. I've tried to make this as simple as possible, but there is a lot of complexity that goes into designing these. I just kind of want to give you an idea, some things to think about if you're working with advisory teams, CPA, pension people, investment people. These are some of the things that you need to understand, at least conceptually, and make sure that you're asking about. Okay, so now we're going to get into some specifics here on the IRA-based plans. If you recall from our little chart today, we're going to focus on the IRA-based plans. So number one, probably heard of the traditional and Roth IRAs. The limit $6,000 plus $1,000 catch up if you're over age 50. frankly, most people on this call, that's not going to be the best retirement plan. Maybe to do a backdoor Roth to get that 6,000 in there. But I like to point it out because it is a type of retirement plan. And by the way, it's not one of my pet peeves. It's not an individual retirement account. It's an individual retirement arrangement is what IRA stands for. But you do not have to have a business plan for that. SEP IRA, the maximum is $56,000. A simple IRA is $13,000 plus $3,000 catch up if you're over age 50. Okay, so as I already mentioned, the individual retirement arrangement is not actually a company-sponsored plan. There's several variations. Number one, what we call the traditional tax deductible contribution. You can also make non-deductible contributions to it. And Roth contributions, which are post-tax, you can do that as well. There are a bunch of limits and phase-outs, so I'm not going to get into that a whole lot today. Suffice to say, I don't think that's anybody on this call, but if someone has a just ridiculously simple business where they're not making hardly anything, you know, it may be just as easy just to stick the money into an IRA. Okay, so let's move on to the SEP. So a SEP stands for Simplified Employee Pension IRA, and it's a form of IRA. So if you think back to that other chart, we had defined contribution, defined benefit plans, and IRA-based plans. So a SEP is an IRA-based plan. So some of the advantages of it, number one, you can exclude employees for 3 years. You do get the tax deduction and deferral of income that you put in. The contributions are not subject, AGI stands for adjusted gross income, so they're not subject to any sort of phase out. You can put a lot more money in than an IRA. Now here's the key, the deadline for a SEP is the return due date, including extensions. And I'll talk about that in a minute, and there are no annual reporting requirements. Generally, the only reason to have a SEP in the year 2019 is if you didn't do any planning and you forgot to do it, like it's February of this year and you didn't do anything for 2018, it's not too late to set up a SEP. And other than that, we generally don't recommend these plans. Some of the disadvantages, number one, employer-only contributions. The employee has no opportunity to defer anything into it. It's 100% employer contribution. And there's also a lower contribution amount for lower earning owners. It's based on a percentage of your pay, and it's equal across everyone in the company. So if you make the most that you can do is 25% of someone's salary. If you're self-employed, there's a little calculation, so that comes out to be 20%. So let's just take the S Corp that pays himself a salary. If you're paying yourself, $10,000 salary, you can only give yourself $2,500 into your SEP. Oh, and by the way, if you're paying somebody, if you have an assistant or something like that, their contribution amount is also whatever yours is. It can be anywhere from 0, you don't have to do it every year, so 0 all the way up to 25% of someone's compensation you can contribute to their SEP. The next type of plan we'll talk about here is the Simple. So the Simple stands for Savings Incentive Match Plans for Employees. It's also a type of IRA. Now, for whatever it's worth, the Simple is not simple because there's also something called a Simple 401k. This is a Simple IRA. Once again, as a general rule, we're not going to recommend Simple, but I want to go through this with you to make sure you understand what they are. You may hear people recommend them. They are somewhat easy to set up, and so sometimes people just end up with a Simple. But some of the advantages, the participant is fully vested. The max contribution is generally greater than an IRA. Those lower income owners can contribute a lot more than a SEP. There's no annual reporting requirements. So it has similar features of the 401k, like the salary deferral and the match, but it doesn't have all the complexity and restrictions of a full-blown 401k. Most of the funds are contributed by the employee. The employer match is relatively small. Some of the disadvantages, It has to be set up by October 1st of the year that contributions are to apply. So for example, it's too late to do it for 2018. Unlike the SEP, where you can wait until you file the return to figure out whether you want to set it up, you can't do that with the Simple. It is only for employers with less than 100 employees. And here's the big one: it has lower elective deferral limits than 401k plans. The Simple came about, at the time it was a good idea when 401k plans were very expensive and they were riddled with fees and things like that. And they came out with this to try to get smaller businesses something cheaper to do. Well, here today, a full-blown 401k with independent companies, not your MetLife or Merrill Lynch or these type of places, but there are independent custodians that are very, very inexpensive to set up a full-blown 401k. And the additional deferral amounts into a regular 401k and some of the other features have largely rendered the Simple, not the plan of choice anymore. This next chart, I put together a little chart here to show you an illustration. So on the left-hand side, we have the different salary levels, starting at someone that makes 40,000 all the way up to somebody that makes 293,000. And I did this to show you the difference between being a sole proprietor, or this could also be like a partner in a partnership, or anything other than a corporation, an LLC member that is self-employed. But over here on the left, you can see the point at which you can maximize the 401k with a basic dollar amount. The maximum contribution to this type of a defined contribution plan or IRA plan is $56,000 this year for someone under 50 and $62,000 for someone over 50. So here I show someone under 50 years old. So you can see at $148,000, someone in a corporation like an S Corp could max their 401k with only $148,000 of salary. The sole proprietor, because of the way that self-employment tax works, they'd have to pay themselves $196,000. That person with the SEP IRA, the corporation, they'd have to pay themselves $224,000 to max that account out. Once again, remember, you're just wasting Social Security and Medicare payroll by doing that. And then if they're the sole proprietor or partnership, they've got to pay themselves a whopping $293,000 of income. Over here on the Simple side, you see they never get to the max of 56,000. I mean, I'm sure there's a number. Oh, there is a number, but it's just ridiculously high. You can't get there. But as you see at the lower income levels here at $40,000, the Simple, you can get there a little bit quicker than the SEP, but for the same salary level, your big bang for your buck is over there on the 401k side. So I just like to point that out when designing the plan. Once again, if you're trying to max out or reach that maximum amount, we're going to want to go with something other than an IRA-based plan. Okay, just another little break here for the allowing for inflation. Make sure you always account for inflation in all of your calculations. Okay, so now we're going to go through a couple of case studies here. I have what I call a small two-person SEP plan that I just took somebody, a sole owner, they make $100,000, they're age 47, they have one employee, 24 years old, they make $25,000. And we go through here and I'll go to the end. So we look at, in this, the principal who made $100,000 gets 80% of the total benefit of that plan, and the employee gets 20%. Okay, so these are what we want to look at. We want to look at, when we design a plan, what percentage of the benefit of the plan goes to whoever you want it to go to. In this particular case, it's definitely skewed towards the owner of the company. We also like to look at the after-tax benefit. So here we look at the 12% bracket. It's actually the net cost of the plan is positive. That means it's costing the owner $2,500 to have this plan in contributions. basically to the employee. But look at this, at the 37% tax bracket, the cost of the plan becomes negative. And that's what we want to see. If we can design a plan where that net cost of the plan is negative, that means that, frankly, you're crazy if you don't do it, because it's a negative cost to have this plan. Now, in my little simple assumptions, there are some plan fees that you have to have a plan, but suffice to say, it's not going to eat up that entire amount. Same company with a simple. We'll take a look at that. On the simple, same thing here, 96.97% of the benefit went to the principals. Once again, because of the deferral, the deferral amount, they're maximizing the deferral. Most of your lower paid employees are not going to maximize your deferral. And then the match is very modest. So here you see at the 12% bracket, a negative cost of the plan. And then at the 37% bracket, still a negative cost, but not quite, there's not a huge jump like there was with the SEP. So now let's go over here to a 13-person company, and let's see kind of a model here. Here we've got people all over the place. We've got 50s, 60s. We've got people in their 20s, 40s, 30s. We've got people making hundreds of thousands, and then people, $24,000, $25,000, 13 employees. So here on the SEP, you can see that you have to contribute the same percent to everybody. Now, I did this just to illustrate it. I mean, you would never, well, I shouldn't say never, but you probably wouldn't do this. But you can see that the contribution of the principals here is only 14%. 85% of the contributions went to the non-principals. And then on the net cost of the plan, you can see at the 12% bracket, 170,000. That's basically the money that you're giving to the employees. Now, you may say, look, that's fine, David. Like, we want to benefit our employees. That's the purpose of the plan. That's what we're trying to do. But that would be the cost of it. At the 37% bracket, it's still costing you $112,000 to have this plan. Then the last one we'll just show you here for the simple plan. Same statistics, same company. Here we've got a little bit better. 60% of the benefit is now accruing to the principals, 39% over to the non-principals. And we do a check of the cost. And here we've got a negative cost at the 12% bracket, as well as the 37% bracket. So when designing a plan, I just wanted to show you these simple examples of how we design the plans and what a drastic difference it makes based on the size of the company and the type of retirement plan, some of the vastly different results that you can get. Okay, so we're getting towards the end here. Next time, our next webinar, we're going to talk about the solo 401k and the safe harbor 401k, which are fantastic options. I highly recommend these over the simple or the SEP. If you set it up in the right calendar year, these are great options for your smaller companies for simple plan design, and we'll talk about those at our next webinar. But that brings us to time for questions. I love this little cartoon. But anyway, okay. So Larry, I haven't really been paying attention, but do we have any questions? We can take them verbally or typed. Nate? Okay, if anyone has any questions, if you can type them into the chat box, or Nate, how do they raise their hand if they have a question, or?
he won't be back till next week. So.
Okay, do we have any questions?
I have a question.
Yes.
Can you hear me, Mr. David?
Yes.
So in our currently set 401k plan, I was talking to them yesterday, and they said we can contribute maximum 19,000 for, so which is 3% on maximum of 280,000. And they said that's the IRS rules. We cannot contribute anymore. Is
Right.
it
So
just
the
that I
19,
because in your chart it was 56,000.
right. So the 19,000 is the maximum salary deferral. So that's the most that an employee can put in. The 56,000 is made up with employer match and profit sharing or other contributions. But you're right, the max that an employee can defer if you're under age 50 is 19,000. If you're over age 50, it's 25,000.
I'm sorry, one more time. So that 56,000, that's how employer, the maximum employer can put in?
That's the maximum that the combination of an employer and employee can put into any one person's account. So, for example, you can put in 19,000 of your money, and then the employer through matching and profit sharing could put in 37,000.
If the percentage, if in our plan percentage would be set up higher, correct?
Right. If you set your plan up in a manner that allows those type of contributions. If it's like a basic safe harbor plan or something like that, you're not going to get anywhere near that type of contribution.
Thank you very much.
Okay. Any other questions?
Hi, David. I have a question if you can hear me.
Yes. Yes.
Yeah. So if hypothetically, you're self-employed, you're the single employee as well, and you're giving yourself a W-2 of about 100,000. Your business earns about 250,000. What would you recommend as the first plan that you would start with? Something that would be simple and that you could set up yourself.
Yeah, so you could do a safe harbor 401k with a profit sharing component to it. If you're the only employee, you could do that, and you could get up to the maximum because you wouldn't have to worry about any non-discrimination testing or anything like that since you're the only employee. But the way to get there, you could get there at $148,000 of salary. You could max out a 401k at the 56,000 level. Now, if you had more than $56,000 available that you wanted to, then we would probably look at adding a cash balance plan on top of that. But the first sort of threshold is to get to the 56,000, and you can get there with a standard safe harbor 401k with a profit sharing component to it.
Great, thank you.
Okay. Well, if you think of anything else, like I said, we'll be doing 5 of these webinars. So write down your questions, bring them to me next time. This, by the way, this group is everybody. We were all in Maui together, so everybody knows me. If you have a question outside of the webinar, feel free to shoot me an email or give me a call. I'm happy to answer that question. But I think if there's no more questions, Nate, I think we can go ahead and wrap up, and we'll see everybody at the next meeting.
There are some questions in the question panel as well.
Oh, okay. I can't see those. Sorry.
Okay, I'll just read them off to you from, and I apologize if I mispronounce your name. First question is Neelam Patlow. David, what do you, it's RECC, not sure what that is, as the recommend as the best, easiest plan for a self-employed business owner. Single owner is the employee. What can you set up for?
Yep,
That was the
so
question I had asked that he just answered. Yeah.
Oh, okay.
that was
Okay.
Neelam. Yeah.
Okay, so the Sherman Ho is for 401k. What cost is reasonable?
So there's a company out there that we use called Employee Fiduciary that for 30 and under employees, the setup fee is like $1,000 or something, and the annual fee is maybe $1,500. And they offer Vanguard and low cost funds, and there are other companies out there, but for a small company 401k, the cost should be in the not more than a couple $1,000
Okay.
at most.
Okay. The next question was just Olga Savage, and I just put the David. Olga, did you have more to your question?
No, I already asked it. I
Okay.
realized I can ask. I just verbal ask.
Okay. Let's see. The next one from Sherman Ho again, as a percentage or an asset. I'm assuming that's goes along with the other question above. Submitted.
Yeah, so the fees, there's usually going to be a flat fee, a flat administration or record keeper fee, which is, $1,000, $1,500, maybe $2,000 that goes to the record keeper. And then some third-party administrators are going to charge an asset-based fee. For the record keeper and the TPA, it should be very low in the, 0.0 something range, 0.05, somewhere in there. Where the fees get a little bit high is when you have an advisor on the plan. And as everybody knows, I'm a flat fee advisor and sort of rail against these type of things. But where they get so expensive is when there's an advisor charging, 0.5% or 1% on the assets in the plan. That's where they get really expensive, or they put funds and investments in the plan that then turn around and charge 1% or 1.5%. But the record keeping, third party administration, the flat fee part of your plan should be very low. And then if you can get by with someone that will help you set it up, help you design the plan and monitor it for a flat fee, that's where you can avoid a lot of those asset-based fees.
Okay. Next question is from Charles Glover. It says, I think I saw a slide that a 60K you can put in 34K in 401K safe harbor.
That's right. 60,000. So that would be and this is for someone under 50, and we don't want to reveal your age, Charlie, but you actually could do more than that because you get the $6,000 catch-up contribution. So for you, it would be even more than that.
Okay. Next question is Bob Lake. Again, max 401K 450 plus old is 25,000 question.
Yes, right. The employee portion of a 401k. If you're over 50, you can defer this year $25,000 of your pay. And I didn't get into this, but one of my favorite techniques is to employ a spouse also. Assuming she's the corporate officer, vice president, secretary, something of the company, you can pay her a salary. And, we do that for my wife, and you can get another 25,000 into the retirement plan by doing that as well.
Okay. Next question. This one's from Sherman Home. We pay about 2% total with advisor at 0.4% flat fee is $1,650. Okay, that wasn't necessarily a question, but
yeah, 2%. That's pretty strong. that's pretty high.
Okay, and that is only questions we have in the questions panel. Does anybody else have questions? You can unmute yourself or write in the question panel.
Okay, well, like I said, feel free to ask me next time or shoot me an email. Happy to answer your questions.
Okay, thank you for everybody for coming.
Okay, we'll see you next time.
Thank you, David.
All right.